Well, let's chat stock picks, particularly given the reflation trade that we continue to talk about and the rotation. James McBeath is joining us now from Paradise Investment Management live in studio. James, good to see you again.
Good morning. Yeah, you too.
Okay, we have this reflation trade ongoing. We talk a lot about what it's mean for those high growth companies. We talk a lot about what it's meant for some of the small cap companies as well. What about those that sit in the middle?
Sure. It's been an interesting start to the year. It's been pretty quick to move. As you'd expect in the mid-cap space, we've seen quite disparate performance between those that have been exposed to that reflation or view to inflation catching back up and those that have been beneficiaries prior. To give you an idea, the best performing stock in the mid-cap 50 is up nearly 30% for the calendar year versus over a 30% fall for the worst performer. And within that, your typical sort of expectations around cyclicals, resource exposed, and particularly the banks and other diversified financials have done reasonably well coming through that. Conversely, those yield sensitive and particularly those tech and the loss-making parts of the universe have definitely struggled to maintain their high valuations that they had in the back half of last year.
So just a reflection then of the overall market.
Pretty much.
Yeah, so your expectation then obviously that inflation is coming, that we're going to continue to see the steepening of the yield curve. How's that then play into the mid-cap sector?
Sure, it's been an interesting time to watch. I mean, the equity market is clearly at this point taking its lead from the bond market, which itself has been playing a bit of a game of chicken really with central banks, particularly offshore. And even as we saw as recently as last night, as expectations sort of wax and wane between how fast that yield curve steepening is likely to come through and then the implications for inflation is obviously helping us inform our view about which sectors outperform from here. I mean, in our view, the key to seeing inflation coming through is obviously going to be employment tightening up, and clearly the stimulus announcements that have been made, particularly in the US, are pretty key to that. But within that, we sort of feel we need to get one level below the aggregates. So to give you an example, I was over in Western Australia for most of last week, and the combination of a very strong resources market and then still some reticence around cross-border travel is making that labour market very tight. And most operators we spoke to are talking about quite material wage inflation coming through already. Conversely, on the East Coast, and notwithstanding the infrastructure spend, it looks like it might be coming through. Obviously, sectors particularly exposed to travel, hospitality and the like are still finding it pretty difficult to generate a profit, and so obviously wage inflation expectations there remain pretty low. So we sort of feel like the aggregates might take a bit longer to catch up than some of those subsector dynamics, and so we're quite careful, particularly as we're thinking about margins of these businesses going forward, just how fast those inflation levels are starting to come through.
So when it comes to that game of chicken you referenced, do you think it's central banks that will blink, or do you think it's financial markets,
yeah,
bond markets?
I mean, that's $1 million question. I think what has been clear is that central banks have been very loud in saying that versus the strategy that was adopted last time we're in this situation, they're very keen to see real data come through before they're going to respond to those inflation expectations. And so on that basis, you would have to think that central banks likely lag bond market expectations. We've already seen that more recently. And you can particularly see that in the way the curve is steepening in terms of people very much banking in that expectation that central banks will be late to move, but that potentially the move that then comes is much steeper than perhaps we've been expecting previously.
Yeah, so what's your expectation? I mean, are you believing the narrative there where that's coming from the central banks at the moment, particularly out of the States and I guess locally too?
Look, at this stage, there's no reason to doubt their view that they are going to be patient and that data is going to take time to come through. I mean, ultimately, from our point of view, we think markets will lead, as they obviously always do, because they're working on an expectation basis. And so really, we're sort of inclined to follow the bond market in this regard. And so that steepening curve that we're seeing now, we think is a reasonable reflection of where things are likely to move from here.
That's the basis of your thinking. Now, what sectors are you favouring? Do you have a few names that you could
Sure.
force feed us?
Yeah, so from our view, I mean, trying to guess the timings around vaccine rollouts, how efficacy is going to play out, the timing of stimulus projects actually hitting the ground is quite difficult. But ultimately, if you take a sort of medium-term view, at some stage we think markets do reset to start thinking about what sort of businesses as we move out of the pandemic continue to be able to offer structural growth in a more normalised economy, for lack of a better word. And so in the mid-cap space, particularly the healthcare space stands out as a space in there. ResMed's one we continue to like in the portfolio, notwithstanding that it's had some issues around COVID short term, particularly around people being able to access sleep labs. But from a longer term growth perspective, we think those drivers remain in place. Fisher & Paykel Healthcare sits in a similar space, which obviously has been a much bigger beneficiary during COVID. but it's still a very excellent management team, and ultimately that longer term growth prospect remains pretty strong there as well.
And confident buying in at these prices currently?
Yeah, so Fisher & Paykel actually isn't in our portfolio at the moment, and that's not a view around, it's not reflective of a view around long-term expectations. It really is that at the moment the market is oscillating around exactly what earnings base to capitalise. We can see that in healthcare, consumer discretionary names as well, and so we have a view of what we think that longer-term earnings trajectory looks like, and so we'll be basing our valuation entry point on that base as opposed to what we're seeing currently.
Yeah.
All right. James, thanks for joining us from Paddy's Investment.
Thanks very much for having us.
Great.